In 2003, it was designed to be the window by which we speak to our agency subrecipients. Basically, this is the middle system between our state accounting system at TWC and our interaction with our agency subrecipients. Many of you are probably familiar with the system. We're going to go through some of the basics, talk about the reporting requirements of accrued expenditures and obligations briefly, and end up with some information that Ms. Partita is going to go through on bonding requirements. So if we can move to the first slide. Starting with the basics, in order to log in to the cash draw and expenditure reporting system, you'll have to go to our website at twc.texas.gov. At the right-hand side of the screen, you'll see a TWC agency information box. And if you follow the steps on the slide here with going to system and related forms, again on the right side, you'll see a link to the cash draw and expenditure reporting system. There'll be, once you click that link, there'll be two links in the next page. One will be used if you are an existing user with a CEDAR system user ID and password, and the other will be a link if you're wanting to request an account for the system if you're a new user. Next slide. This is the login page that you'll see once you do click the link to log into our CEDAR system. And if you have an established user ID and password, here's where you'd enter it and log in. If you need to request a new account, you'll see on the right-hand side of the screen and underlined request an account. And so that's where you'd click if you're a new user and you need to establish a new credentials in our system. This screen is where you'll go to request a new account. There's some basic information that's required, name, email address. You'll establish your user ID and password for the system, given the parameters that are provided. And you'll also respond to a few security questions so that we can help you reset your password in the event that you have troubles with it. And finally, you'll indicate whether you're a TWC internal user or a vendor or subrecipient of the agency, and then you'd submit. If you're requesting a new account and you submit information from the previous page, you'll be given provisional access to the system. And what that means is you're really not able to do the things that you're going to need to do, such as initiating cash draws and reporting expenditures until you've gone through the 11 training modules for the cash draw and expenditure reporting system. This tab kind of gives you an indication of what is included in each of those training modules, including how to navigate the system, how to prepare cash draws and adjustments, how to submit transactions, and how to prepare your and certify expenditure reports or contract closeout packages. So once you've gone through the training modules and been given full access to the system and you log in, I want to go over some of the important pages in the system itself and what they do and how they work, many of which you'll understand after having gone through the training modules. But as an overview, you'll notice the first screen you'll come to when you log in is your home page, and there's a lot of important information on the home page. The things that you'll immediately notice are there are tabs across the top that go to the individual modules within the system, the expenditure report module, the cash draw module, the reports module, and there's also a help section if you're having troubles. Those links are also at the bottom of the page. But some other important things to note that are on this page are system messages, which is the top box on the home page. That basically, if we may include a message if there's some scheduled system maintenance or some reason the system may be going down temporarily, or if there's other important things that you need to know about upcoming deadlines and things of that nature. Also included is a section where there are actions required by the vendor. So there may be a cash draw that's been submitted that it's still needing some attention to finalize a pending request and things of that nature. There's a box for contract closeout notifications, and there's a box that indicates the pending cash draw request that you have initiated in the system. And finally, there's a voucher payment notification box. So there's a lot of information on this home page that is right at your fingertips to help you as you navigate through the system. Additionally, you'll find as you navigate through the cash draw and expenditure reporting system that there'll be numerous places where there's blue text that is underlined, and those are all links that will take you to another module or page within the system. The quick nav section on the left-hand side of the home page is very handy to get you to various pages within the system in a quick way if you're wanting to initiate a cash draw or certify an expenditure or various other things. It's a nice tool to be able to do that without navigating through the various tabs. So the other tab on besides your My Home tab, there are two additional tabs you'll see. These aren't the tabs at the top of the page, but they're at the middle. The second tab is the My Profile tab, and this has information about you individually as a user, your name, email, security information. This is where you'd go to reset your password or change your security question responses. The third of the three tabs is the vendor profile page. This has some pertinent information about the entity who we've contracted with, including the address of the entity, who has the ability to submit cash draws for that entity. It has vendor bond liability history information and the box that you'll see in the middle of the screen, as well as lockout history and email notification. And the lockout history component, for example, may be, it's not necessarily because of a late reporting. I mean, there's also situations, for example, where we lock all vendors out at the end of the fiscal year so that we can close down the fiscal year. And so each August, we typically will send everyone an email letting them know when the system will be unavailable, so that they can plan accordingly. So now we're going to go through some other screens that you'll need to understand as you manage the grant contract that you've been awarded. The first of which will be the cash draw request screen. And you can see at the top of the page that we've navigated to this screen by going to the cash draw tab. And once we do that, what it will do is it will provide you a list of all of the active contracts that you have with us. And you can use the select buttons to the left of the box to pick a particular contract from which you'd like to draw funds. Then you'll have to enter a service date of the transaction. And you'll need to remember that the service date will need to be within the contract period. And then you'd hit next in this case to continue the initiation of a cash draw request. And once you do that, the system will determine, based on the contracts that you've selected and based on the service date that you've indicated, which funding sources are available for you to draw funds. What you'll see here is information that is consistent with the way the purchase order is established in what we call our TWC accounting system, which we refer to as RAPS, and you'll see that indicated from time to time throughout the presentation. But this displays based on the service date and the contract selection, the purchase order lines that are available to be drawn and the balances. So you would include the amounts that you intend to draw here to continue initiating a cash draw request. Some things to keep in mind when you are initiating a cash request is that you can only initiate a request in situations where there's an available balance. In other words, that you haven't already drawn the entire amount for that particular contract and service date combination. And also that it's prior to 90 days after the end date of the contract. So in the 90 days, typically the system is going to initiate a final which is due 60 days after the end of the contract period. And the reason that 90 days is even more of a constraint is that that's when POs are basically cleaned up from our accounting system perspective, and so we're unable to, in some cases, reflect those changes directly to the PO. So, and again, as we've noted, from that particular screen, select the contract that you'd like to draw from and an appropriate service date within the contract period. But also remember, the service date can't be a future date. So, few additional things to keep in mind as you're initiating cash draw requests is that you'll enter, the appropriate amount that you'd like to draw from each particular contract line and save the request. And you can only do one request per contract at a time, but you can do multiple draw requests in any given day. Also, and this is important, the cash draws are, with respect to the way the system works, are independent of the reported expenditures. So we're going to go through the expenditure reporting section later in the presentation, and in which we'll talk about monthly reporting deadlines. But basically you can go into the cash draw system and draw cash as needed through the life of the contract, subject to the 3-day cash rule of the Cash Management Improvement Act, meaning that you don't have more than 3 days of your cash needs on hand at any time, but you can draw throughout the life of the contract. It doesn't necessarily have to be consistent with the date in which you're reporting your expenses. And also, cash draws are assigned a transaction number when you save them, so that is also another way that you can easily search for a particular draw request if you've initiated one. Service dates we've talked about need to be between the contract begin and end dates, obviously, because the service of the service date related to the good or service when it's received needs to be within that contract period, and that service date that you enter, again, will dictate which funding lines or PO lines within your contract are available for you to initiate a draw request based on the characteristics of the underlying grant funding. And what the system will do as well is that if you initiate a draw request and there is older funding that exists that could be used for the same purpose, the system will alert you to that fact to kind of promote basically FIFOing and using older funding first, but it will not stop the transaction. It will just let you make sure that you're aware that older funding may exist in cases where you may have multiple contracts and things. Also, the system will not allow you to draw more than is available. I think we've talked about that. And the system will not allow you to draw more than 20% of the total contract amount in any given day. And that edit was built into the system from the beginning, basically to help in the event of a typo or something that someone inadvertently requested significantly more than they wanted. And we don't suspect during the life of the contract that there would be a need to draw more than 20% of the contract on any given day. And further, the system will not allow the total of the draws submitted over a 3-day period to exceed the vendor's bond liability. And Ms. Partita will be talking about that later in the presentation. So here's another important page. This is also in the Cash Draw tab, the Contract Detail page. This particular page has a lot of useful information in terms of, again, your particular purchase orders related to your contract. And you'll notice as a general theme when you walk through the system that many of the pages have summary information at the top, including the contract number, begin and end dates, the current contract budget, which is the contract amount, how much cash has been requested to date, that sort of thing. In this particular case, it shows the cash balance, due to, due from, and some of the expenditure reporting tabs. It'll show the reported expended, the cash drawn, and the due to, due from. But you'll see in the middle section of this page, it kind of shows the PO line details for all the available funding in this particular contract. So it'll show the current budget, which is what the purchase orders are established at in the system, the sum of which ties to your contract amount, the cumulative request total to date, so this is what has been requested and provided to date, any requests that may be in process, and then the balances that you have to draw against this contract. Also, the bottom box on this page will show a history of the draw transactions that have been made against this contract. It shows the line description, the date of the transaction, and the status, whether it's complete or it's processing, and then the amount. So a lot of good information on this page about the draw history of a particular contract. Just to reiterate, the contract detail page gives detailed contract information with PO line information and also a history of the draw transactions that have been created and their status. So it's a pretty good resource within the system. So now we'll talk a little bit about the expenditure reporting section of the system. And this is the system that our unit within financial reporting here at TWC deals with more so. The cash draw component that we just kind of gone through briefly, the contracts payable department within finance here at TWC deals with that, and we're always in close communication throughout the life of these subrecipient contracts on activities and what any issues that our subrecipients may have with the system or otherwise. As an overview, the expenditure reporting system, we're going to talk about the deadlines and things here shortly, but just in general, how the system was designed is to capture from the expenditure side expenditures on a monthly basis through the life of the contract. And so our grantees will enter those expenditures. The system will go through a series of edit checks where it looks at, are your expenditures and or obligations within your budgets for each particular cost category. And then if they are, the report will go to ready for review status, meaning it's passed all its edit checks. And the individual who has the ability to certify the report within your entity will certify, and that will allow TWC to post the report. Now, if the report's not certified timely, the system will generate email messages to each entity each day until the report is certified. Once these reports get certified and posted, they go and they interface with our RAPS accounting system here at TWC. And so we use that information. We accumulate or compile expenditure information to report to the federal awarding agencies. So what do you report on the expenditure side? Accrued expenditures, obligations, program income, and supplemental categories if they're required. For the AEL program, in the beginning there were a pretty extensive set of supplemental cost categories, which we have moved away from, but that is a section that we use to get additional information about a particular subrecipient contract. And monthly reporting is mandatory. So once you have an initiated contract with TWC and you have a user who has the ability to certify those reports, they have to be done on a monthly basis. Even if you have no activity, the expectation is that you'll go in and enter 0 in terms of expenditures or obligations, and then certify that report as a 0 report so that we know that you have completed the report and have no expenditures instead of kind of guessing that, since you know, if it weren't to be completed. So TWC rule defines accrued expenditures as charges incurred during a given period for goods and tangible property received and services performed that cause decreases in net financial resources. The important thing to know about accruals is that it is for goods and services that you've received as of the end of the reporting period. So even if you haven't paid for them, if you've received the good or service, it should be accrued and accounted for in your monthly expenditure report for the month in which you've received it. What sort of documentation may you need to determine your accruals? Listed here: time records, invoices, receiving reports, contracts, travel expense reports. I mean, these are all examples of things that you may use to determine the appropriate accruals to attribute to your monthly expenditure report. And again, the system is designed, and the instructions ask that you report accrued expenditures. You know, we understand that you know, likely your accounting system is on a cash basis, as is ours. But you know, you just have to have the ability to have a methodology by which to estimate those accruals so that they can be added to the monthly activities. We have a similar methodology by which, again, we have a cash-based system by which we recognize state-level accruals. We accumulate that information along with the information that you report to us to certify to the federal awarding agency an accrued expenditure and obligation total for the state. Next, we're going to talk about obligations. And again, by rule, obligations are defined by debt established by legally binding contract, letter of agreement, subaward, or purchase order that is executed before the end of the contract period, but it has to be for goods and services that you expect to be provided by the end of the contract period. Again, that falls back into the having a service date within your grant period. Also, you should expect to liquidate within 60 calendar days after the end of the contract period. And the reason for that is that's consistent with the closeout period that is hard-coded in the cash draw and expenditure reporting system. Here are some of the characteristics of obligations. There should be a need. In other words, you know, there should be, you can't just buy a bunch of stuff toward the end of the contract period because you have extra money available. It should be something that's needed for the program during the contract period. It has to be something that's written, legal commitment. There are different types of agreements. You know, when you talk about things like definite or indefinite quantity, purchase orders, or agreements, you know, if it's a definite quantity then that you expect to receive within the contract period, then you would obligate the entire amount until such time as you receive the goods and services, and they turn into an accrued expense. If it's an indefinite quantity, you would only obligate the minimum amount that you're required to purchase during the contract period. And other characteristics, you know, it's something that's legally binding. Also, keep in mind the delivery date, or, you know, as far as your contract period, make sure it's within the contract period, the expected delivery date. And if you have multi-year contracts and and contracts with option years, you know, with other entities, then you should only obligate what, you know, for the goods and services that you expect to receive within the contract period that you have the contract with TWC, and not the future years until such time as you actually get an extension of your contract. That's important to know with respect to how you recognize obligations. And obligations can occur at the same time as an expenditure, prior to or the same time. So, you know, if you order some goods or services this month and receive them, you know, at the time you ordered them, you had an obligation, but if you received them the same month, they turned into an accrued expense. And so, last thing, budgets and plans are not obligations. So, you know, one big one is future employee salaries. You know, if it's not contract labor, then it's not an obligation in that case. So, you know, what do obligations tell us and why are they important? You know, basically when you look at the total obligations and accrued expenditures for a particular cost category on your report, that'll tell us what you have legally committed against your contract, you know, for each particular cost category that has been established. And it also tells you how much that you have remaining to do other things with, you know, within the contract period. It can help you to avoid overcommitting your contract. In other words, if you know you're legally bound to purchase this amount of goods and services during the contract period, and you know you need to know that you have enough to cover what you're committed to, and you need to know what you have remaining to manage the rest of your contract period. And another reason this is important is in many cases you may not have an alternate funding source should you overcommit your particular grant contract. You know, there may not be something that you can turn to fund those overages if it comes to that. So just to recap, I mean, we track obligations because it's a good grant management practice, you know, in order to make sure that we're properly managing our grant contract. Obligations are generally supported by documentation and reflect legally binding debt. It's always important that it's an activity that's allowable under the grant, and that it occurs within the contract period or period of availability of the funds. And just to reiterate, budgets and plans don't represent a binding legal agreement, so they would not be considered an obligation. So moving into the types of reports that are in the cash draw and expenditure reporting system, there are monthly reports, final reports, and revised final reports if necessary. And we'll go through each of those briefly. So monthly reports are generated on the first of each month, and they're due on the 20th of the month. And so basically you're reporting for the previous month's activity. As an example, August 1st, a new expenditure report will be generated if you have an active contract with us. This will be for the report month of July 2020, and it will be due August 20th. And it's important to remember that due dates of these reports are irrespective of weekends and holidays. So the 20th falls on a Saturday or on, any other holiday or otherwise, the system is not, it's a hard-coded date-based system. So keep in mind, if you happen to be an entity who's a fiscal agent for a consortium, that these deadlines are hard-coded, and if you need to gather information from other members of your consortium, that you do that in a timely enough manner to be able to comply with the 20th deadline. If we don't receive a certified report from you by the 20th of the month, which is the due date, we can at TWC initiate a zero report for you for the month. Now, that is something we try not to do because we desperately need the information to compile our reports. So we try to reach out and, once we see that there's a late report, we try to reach out to each entity and see how we can help them compile that report so that we can get the information that we need to compile for federal reporting purposes and otherwise. We'll look at a couple of these things shortly, but the expenditure report work list is an important page in the expenditure reporting module, and it will let you know which reports are due and what kind of reports are due. So it'll show the list of monthly reports, or if you have final or revised final reports that are out there that are due, it will show you that list all on one page so that you'll be able to quickly see the reports that need some attention. And you can continue to modify reports until they're posted in our system. So if you've certified a report, say before the deadline, and notice that you need to make a change, you can go in there and make that change. Once you start that process, it will kick the report back out of certified status into draft status, and so you'll have to go back through the process of edit checking, which will give the report a ready for review status, and then recertify the report. Once the report is posted, which we post them here at TWC after the 20th, then it can no longer be changed. And we'll talk about that here shortly, but we're going to go through some of the samples of those reports as well. Final reports are due 60 days after the end of the contract. Again, that's another hard-coded date, so keep that in mind. And also keep in mind that the due to due from has to be equal zero. Has to equal zero, meaning the cash that you've drawn and your reported expenditures have to be the same. When you're closing out the contract, or it will not allow you to certify your final report. Grantees can change a monthly report to a final if they've spent the full contract, or have another reason to close it out. Just keep in mind that when you do change your monthly to a final, you'll need to make sure that that due to, due from is 0, meaning that what you've reported spent and what you've drawn cash are the same. And you'll also have to be prepared to go ahead and process the contract closeout package at the same time. Final reports, once they're certified, same with revised finals, are uploaded nightly into our accounting system. Revised final reports, they're only can be created by TDBC staff in our reporting section, and this can occur when you've created a final, but there's some update that needs to be made, or you had a reduction of expense or something that needs to be accounted for, and contact the contracts payable department here at TDBC to start that process. And these are the only reports that can have a due to, due from that may not be equal 0, and that's because if it's, for example, a contract that's been closed out for 90 days and money has to go back and we can't apply it to the PO, then we'll have to just key it to our accounts payable module, and it'll have a different amount. So that's the only case in which their due to, due from could possibly not be 0. And the due dates on revised finals, we try to work with you to give you ample time to do the processing that you need. So we'll initiate specific dates after we communicate with you. These also are loaded on a daily basis into our TDBC accounting system. Here's an example of the expenditure report work list that we talked about before. Another good page. This shows the revised final report and monthly reports that are coming due. You'll see in this particular example there are 3 monthly reports in the middle box on the page. And you can see the report status on the far right indicating no report, which means that there's no action that had been taken on them at this point. But this is a good page within the expenditure reports module for you to quickly see what's coming due. And this is an expenditure report summary, which is also very helpful. Again, as we mentioned in the contract detail page, there's a lot of useful information at the top of the page, including your contract budget, the cumulative requested total, meaning how much cash you've requested as of this date, your due to, due from. The top box, or the box under the expenditure heading, represents the cost categories that are established for this report and what you're using to report your expenses on a monthly basis and obligations, which you'll see the 2 unique columns there. And this particular box represents the current activities, meaning the current month, and this being a report month for May of 2020 in this example, this is what's being reported for the current month. And on the next slide, which is further down the page in the same worksheet, you'll see the cumulative totals, both the budgeted amounts by cost category, the cumulative expenditures that have been reported to date with the current month activities that you'd seen previously, the balance, basically the unexpended balance, then what's been reported obligated against the contract. Further, you'd see program income activities if reported, and also supplemental cost categories, which we don't have, aren't as robust as they had previously been. And when you're processing your monthly reports, and you take them from developing a report draft to running through the edit checks, status moving to ready for review, then the individual within your entity that has the ability to certify the report will go to this page, the Expenditure Report Certification Summary. And here they can select, for example, in the monthly reports box, they can select the contracts that are in ready for review status, and they go to the bottom and click the little box and the certify button to certify the monthly reports. Once those monthly reports are certified, then there's no more action needed at the subrecipient level. After the 20th, they'll be posted by TWC staff to our RAPS accounting system. Some edits to keep in mind on the expenditure reporting side of the system. The system will require an explanation if your monthly expenditures are less than 5% of the total contract amount. And there's a drop down of different potential explanations, or you can customize the explanation. It could be that you're in the second year of your contract and you're still spending older money, or there could be a number of reasons, but this is just to help us get a better understanding of why the expenditure levels may be lower. Also, the edits that have been built into the system basically require that the sum of the expenditures and obligations have to be less than or equal to the cost category budget. So if you try to exceed that budget category, it will give you an error. And that applies also to admin, which is its own unique cost category within the system. So on a monthly basis, you'll be reporting your expenditures and obligations, and also you'll be reporting any adjustments that you may have related to a prior period, because as we had mentioned, once we post these reports to the system, they can no longer be changed, so you have to go in and make those adjustments in a current period such that your cumulative expenditures as of the end of the period are accurate. Also, enter zero if no activity. We've talked about that, and they're due on the 20th calendar day by 9:59 or 11:59 p.m. That's just a hard edit coded into the system. Late notifications, you'll get emails if the monthly report or the final report is late. TWC staff also get those emails, and the email doesn't specify exactly which contract or report is late. You'll have to go into the system and identify it, or you can contact us and we will help you determine which report is late. Cash draw cutoff, if the report is more than 5 calendar days late, the system can automatically cut off your cash draw privileges, and that basically is not just for the particular report that's late, but if you have multiple contracts with us, you as a particular entity will not be able to draw cash on any of those contracts until that report is submitted. Now, we had suspended that functionality for a couple months during the early stages of this pandemic period, understanding that there were a number of challenges to accumulate data and report timely, but those rules have been put back in place, so just keep that in mind. And you can always email cashdraw.ta if you want to know if your cash access has been restored, and or if you want to know which report's late. With that, I'm going to turn it over to Ms. Partita to talk about bonding.
Hello all, this is Susan. This is going to be short. The majority of y'all are educational institutions, ISDs, junior colleges, and as such, you don't require a fidelity bond be provided to us. This slide is just basic. A lot of people ask, what's a fidelity bond? For those of you that are required to get one and to send it in, it's basically just a form of insurance that protects against any losses. In most cases, what we're worried about is just if there was fraudulent activity or dishonest activities going on from some of your employees. Let's see. The requirements, as I said, except for educational institutions, you must obtain a fidelity bond that protects TWC against any losses arising from fraudulent or dishonest acts from your officers and employees. A copy of the bond form must be sent to TWC. You as the grantee must be the insured entity, and TWC must be named as an assigned certificate holder on that. As you send the bonds in to payables.cedar, we will be checking it, and if we see any issues with what's being relayed to us on the bond form, we will contact you and work with you to get what we need. So we get questions of how much should it be, and it should cover the largest cumulative amount of all cash that you could submit and have in your possession in any 3-day period. This goes back to one of the rules that Tim mentioned earlier, that the system will check against your bond amount for a rolling 3-day period to make sure that you haven't drawn in excess of your bond amount or the 20% of your contracts. Another note is that it needs to be executed by a corporate surety or a surety holding certificates of authority and that are authorized to do business in the state of Texas. For those of you who are not required to send in a bond to us, contracts payable staff will calculate 20% of all of your active contract totals and use that as your bond limit in the cash draw system. Looks like we have a couple of questions out there published. This here is just a copy of the form that we generally see come in. By all means, it's not the only form that we accept. It is just the one that we see most often. If you need a copy of it, a blank form that you want to give to your insurance carrier, we can provide one. Now, as I said, very quick, but I know that there's likely questions. Let's see. We can't get an employee dishonesty bond beyond $100,000, and it limits your drawdown ability. The $100,000, depending on how large your contract is, it should be sufficient because you can draw that $100,000 every 3 days.
So I see we also have a question on, it says, we were told with our AEL contracts to put in payroll future months into an obligation, right or wrong to do this. So assuming this is talking about a situation where, for example, a teacher may work 9 months out of the year but gets paid 12 months. If you're legally committed to pay for the 3 months after the 9 months that have been worked, then effectively they have earned that salary at that point, even though it hasn't been paid, and should be accrued.
Do we have any other questions? I guess we can hold it open for a little bit longer. We're almost at the 10 o'clock mark for y'all's break. If y'all think of specific questions to your situation, you may always email to payables.cedar or cashdraw.ta@twc.state.tx.us, and your questions can be answered through email like that also.
Well, thank you so much. This is Elena, Tim and Susan and Tim and all of the finance staff who we have on with us today, who for this first session, you have all done a wonderful job and provided so much needed information. And we really appreciate all of you. And just to give a shout out, so our presenters were Tim Obranovsky and Susan Partida, and we have Tim Alvarez and several other staff members who are looking and moderating those chats. We also have Beth and Krista from our Train PD who were moderating those Q&A sessions. And so here we are getting ready for a break, and any last minute questions, please feel free to submit them in our Q&A. That will remain open during the break in case you have anything last minute, and we will be sure to get those questions to our finance office. All right, so I think we are getting ready for a break. And so join us back again at 10:30 for our next session with Jenny Noren, and we will see you then. Thank you so much for joining us this morning. And for those of you who are still on, there is a announcement in the Q&A section for you. If you have a moment, please take a quick survey. Let us know your experience of this session using Teams live event. We would love to have your feedback, especially as we prepare for our Fall Institute. So just take a moment. You can stand up, stretch, get some coffee, take that brief survey, and then we'll see you back again at 10:30. Hello, everyone. This is Elena from our Adult Education and Literacy Office. Just kind of checking in during intermission. We have about 10 minutes left before we kind of start our sessions off with some introduction and navigation slides. For those 62 attendees who are still logged on, feel free to take a moment and fill out our post-session survey. You can find that link in your Q&A under the featured tab. And so just take a moment and fill that out for us. Let us know your experience of Microsoft Teams live event and how you think our session went. And so we will get started with our next session, upcoming Jenny Noren on cost principles at 10:30. So we'll see you back soon. Good morning, everyone. This is Elena Zachman with the Adult Education and Literacy Office. Welcome to our summer business meeting, session 2, which will get started shortly at 10:30. So before we begin, we are going to do a little housekeeping, give you some navigation and introduction if first time using a live event. And so we appreciate you being with us, and we're excited for this next session. On your screen, in the top right-hand corner, you see a few icons. One of those is leave. So if you need to leave this session at any rate, you can click that button and then reopen this using the same link you received during registration. You will also see the Q&A icon, which is a dialog bubble with a question mark, as well as some of your settings and meeting information. At the bottom right-hand corner, you will see the closed captioning, as well as the controls for making this a full screen. If you have a question during the session, please feel free to ask at the top right-hand corner. You're going to see this Q&A icon, and you will see the featured tab, which is everything that our moderators will publish, as well as the My Questions tab, which is everything that you ask and our moderators reply to you privately. You are also able to filter by the most recent questions or the most likes. So feel free to give a question a thumbs up. At the bottom of the screen, you will see a purple Ask a Question button. This will take you to the Q&A pane under My Questions tab. Be sure to type your full name next to the icon of the person, and then type your question here, right below your name. Once you've typed your question, be sure to use the paper airplane icon to submit it. And our presentation will begin in a few moments. We have our cost principles session with Jenny Noren. And I believe we have a brief introduction by our interim director, Mahalia Baldini, coming up.
Good morning. Always multitasking. How's everybody doing this morning? I just wanted to briefly say thank you so much for joining us. This is our second session of the day. We're thrilled to have you here. This session is going to be on cost principles, as Elena said, with Jenny Noren. Jenny Noren is an amazing asset to our team and a real extension for us with all things related to fiscal policy. So when grantees and you guys send us those great questions and we're like, we've really got to figure out what is the policy behind this, Jenny's our go-to person, so we're thrilled to have her. I'm going to be acting in a student role today as well and paying close attention, so I would really encourage all of you, if you have questions, make sure you're asking those questions because Jenny is likely going to have some really great answers and insights for us today. So with that, I'm going to turn it over to you, Jenny. Welcome.
Thank you. Good morning, everyone. Thank you for having me. Like I said, I think this is the third time now we've said this is the cost principles session. My name is Jenny Noren. I'm with the TWC Financial Initiatives Unit, and that's in our finance department here at TWC. So we do a lot of different things. One of those different things is, as Mahalia said, we get those doozies of questions that you guys send that the grant manager are kind of like, huh, and AL staff are like, huh, I don't know. So we get those from you guys, and we get those from all over the place. And so we do our best to look into those and coordinate those responses as we need to within the agency, including our legal staff where appropriate. And so we're very happy to do that. I've been with the agency about 20 years, and so I have a lot of background history, and comes in handy with all these kinds of questions. Today, the cost principle session, this will probably be the most benefit for folks who are just looking for a refresher, or who kind of not really familiar with what cost principles mean when we say that, and just kind of an introductory kind of course. Or for those of you who are like, well, when TWC tells me that it's allowable or not, what are they really thinking about? What are they really looking at? So for those kinds of head scratchers, I think it may be helpful as well. So with that, oh, and questions. Questions, as you have them throughout the sessions, feel free to pop them in the chat box. I'll try to answer them as I go. Hopefully with the help of our moderators, we'll be able to pinpoint those and pause briefly. And then hopefully have a little time at the very end for questions as well. This is a full 1 hour session, so we'll answer as many questions as we can. If there are any we can't get to or that are a little more complex, we'll follow up with those afterwards. So with that, I'm going to turn my video back off, and we'll get started with the whole session. So again, thank you all for joining, and we'll get going. Okay, so you can go ahead and go to the next slide if you would. Okay, so the objectives of this session, we're going to kind of look at what role the cost principles play in grant management and where to find those little buggers. They're not all that elusive, but if you don't know what we're talking about or haven't dealt with them before, you may not know where to look even. So we're going to look at those, and we're also going to talk about some selected topics. Cost principles is a pretty wide topic or set of topics, surprisingly. And so we're going to focus in on a few today that kind of are more hard-hitting and kind of very key to the basic understanding of things, including those general allowability factors. You may notice necessary and reasonable, allocable, those kinds of things. So we're going to touch on those among other things today. And then we're also going to touch base on a U.S. Department of Education requirement relating to indirect cost rates, particularly the restricted indirect cost rate. And we'll just kind of highlight that, not go into a whole lot of detail on it, but touch base on it, like I said. So next slide. And next slide. We're going to start with cost principles, like I said, the role that they play and where to find them. So this first slide is just a reminder to us all that, all the grant funds that we handle at TWC and that you're receiving from TWC are public funds. They come from tax revenues that we've all paid in. Hopefully we've paid our taxes. If you've paid your taxes, that's where they come from. And as they go through the system, get layers and layers of requirements added on top of them. So from the federal appropriation piece down to the federal awarding agency and down to then us and their state requirements in between, and then the grant terms and conditions. So there's a lot of different requirements that get layered in. And you, of course, as the grantee and your sub-grantees, sub-recipients have the responsibility to comply with those, as we do to, our funding sources. And as we have a responsibility to oversee those, to make sure that compliance is happening. So just a reminder of all of that. That's what this little fun screen is about. So with that, I think we can go to the next slide. We all love being compliant. Nobody likes, first of all, writing up findings. Nobody likes receiving findings. Everybody hates question costs. So what does that mean? Well, with grant requirements, that really embodies everything in your grant award. So there's, like I said, the laws that come down through all the different levels, the regulations, and the uniform guidance and UGMs, which is where we're going to be focusing our time and attention on today, and then the terms and conditions of the grant award. So next slide. So often we get asked the question of how do I know if it's allowable or not? Well, it's really a deceptively simple answer. It's if it meets the grant requirements, then it's allowable. And if it doesn't, well, then it's not. So we're going to talk a little about what that means from the cost principles perspective. And again, when we think about allowability, we're thinking about the grant requirements as a whole, not necessarily just the cost principles. They're kind of a starting point for us. So we're thinking about everything as a whole. See, next slide. So where do those come from? The cost principles come from the Uniform Guidance, or UG, which is codified at 2 CFR Part 200. You probably recognize it as one of those identifiers. And of course, the Department of Ed has codified their implementing regulations for the UG at 2 CFR Part 3474. So that's the federal piece. That's the Office of Management and Budget. And then at the state level, we also have UGMS, Uniform Grant Management Standards, and this is published by our state comptroller's office. Both of those, they have a lot of overlap and similarities, the UG and UGMS. Both of them include 3 parts. One of those is the administrative requirements, things like property standards and procurement standards and access to records and record retention, fun stuff like that. Then there's a section on cost principles, and then third, there's a piece on audit requirements that each of them have. So we're just focusing in today on the cost principle piece of those. And again, as a reminder, we're talking about cost principles. When we're talking about allowability, we also have to keep in mind the other grant requirements as well. So if you move on to the next slide, please. The Uniform Guidance, as sort of an intro to its discussion on cost principles, it has what it labels as a policy guide. It's section 2 CFR 200.400. And what this does is it, as the slide says, has the fundamental premises on which the cost principles are based. So what that means is these are kind of things that you have to keep in the back of your mind when you're thinking about allowability and thinking about the cost principles in whole. So I'm going to go over these just really briefly. I wanted to put them on here just in case you hadn't seen them before or you weren't aware of them. They're, of course, there in the UG if you want to go look at them yourself. So the first of those is that the grantee is responsible for efficient, effective grant administration and through the application of sound business practices. So with respect to allowability, one of the things that we think about is improper expenditures. And that's not only just relating to compliance, that's also relating to wastefulness. And efficiency kind of goes hand in hand with that. So the efficiency piece, we want to do things as efficiently as we can, within reason. And then the effective grant administration is, are we achieving the results that everything is targeting, that the program is targeting, that the grant award is targeting, that your organization has specified that you're going to accomplish under that particular project. So that's the effective piece of it, the efficient and effective. Sound business practices is a fun one because some people say, well, what does that mean? If you go and Google it, you will find all kinds of different things, but they all kind of focus centralized, around kind of some common ideas or thoughts, concepts. And for our purposes, some of those would be, for example, just thinking about your responsibilities with respect to the program and the participants, the customers themselves, the students, your employees, and of course the government, because that's where all this money comes from. So thinking about things like that, as well as the legality of things. Obviously, we don't want to do anything that's illegal. And just the circumstances that are surrounding the particular cost. So alignment with your policies and procedures, though, as well, kind of keeping things consistent. So that's kind of some examples of what we're thinking about with sound business practices. The second bullet there relates to the compliance requirements, that everybody has to comply with those. The third bullet is interesting, that it recognizes that every grantee, every subrecipient, every grant recipient has its own unique combination of staff and facilities. Everybody does things a little bit their own way and has their own unique structures for doing things. And so it's recognizing that. And that kind of forecasts a little bit into one of the cost principles that I kind of just mentioned a second ago about doing things consistent with how you ordinarily do for your other operations. we don't want costs to be treated differently for AEL unless there's a really good reason to do that. So you'll have procedures in place in your organization and how you ordinarily record expenditures and accrue expenditures and that sort of thing. And so those kinds of things we want to see handled consistently across the grant award, like I said, unless there's a specific reason not to. So on the next slide, the first one is fun. This is where your accounting folks, I don't know how many accounting folks we have on the call today, on the meeting today, but if you're not accounting folks, this is where you probably want to look to them and go, what does this mean? So this is your accounting practices, how things are handled and aligning those with the cost principles. You know, within accounting practices, we have generally accepted accounting practices or GAAP, and that kind of makes sure that all organizations are kind of treating the similar types of costs similarly in terms of how they accrue and how they record and report in their financial statements. The cost principles are similar to that, but on a cost determination level. So the cost principles, whether you receive one award or 2 awards or 100 awards or thousands, heaven help you if you have to manage thousands of awards. But they're kind of designed to have consistency across how cost allowability determinations are made. So that's that piece of it. The next one has to do with your cognizant agency, the entity, if you have an indirect cost rate, the entity that negotiates your indirect cost rate for you, and just their responsibility to make sure that cost principles are applied consistently to the best of their ability to tell as they're negotiating that rate. And then the last policy guidance point that pulled in from the UG relates to profit. So ordinarily, profit is not something that's allowable under grant awards. Especially for entities that are nonprofit organizations. For profit, there's sometimes some exceptions for those. So what this means is if you have grant funds left over at the end of the grant award, you didn't fully expend the grant, you don't get to keep those. And it also means, not that we've ever seen anybody do that, and I hope we never do, but that's one piece of it. And the other piece of it is if there's income generated during the grant award. Tim Urbanowski mentioned, you know, one of the CEDAR reporting elements is program income. So if you have income generated during the grant award, you'd be required to report that. And then there's separate requirements for how that's handled in terms of how it's used, and it has to be used during the grant award. So that's the policy guide background. So next slide. Okay. When we talk about cost principles, they kind of break down into 3 general categories. Those being basic considerations, direct and indirect costs, and then the general provisions for selected item of cost. We're going to touch on bits and pieces of each of these today. We're not going to cover all of them in their full detail because we just don't have the time for that. But we are going to touch on factors affecting allowability of costs, reasonable cost, allocable costs, applicable credits, written approval. And then under direct and indirect costs, we're going to cover direct and indirect costs and how that relates to cost allocation and indirect cost rates. And then the general provisions, we're going to talk about some pieces that are to keep in mind as you're looking through and referring to the individual cost items that the UG and UGMs do address. So on the next slide, I think I've gotten a little ahead of myself, telling you what we're going to cover. And in addition to that, we're going to wrap up at the very end with just some allowable cost findings. So this kind of is reiterating what I just said in terms of what we're going to cover today. So we're focusing in, we've got all of the grant requirements, and then we're sort of funneling into the cost principles, and now we're funneling those cost principles. We're focusing on some specific ones in this session. So next slide, please. Okay. We're going to start with direct and indirect costs. Thank you. So before we get started in terms of what's a direct cost versus an indirect cost, I want to start with a little other terminology, which is total cost, applicable credits, and project costs. So when we talk about the total cost of a grant award, this is what you're reporting in your expenditures. When you report in CEDAR, these are your total costs. So these are the allowable direct costs plus the allocable indirect costs minus applicable credits. So we're going to, like I said, touch on indirect and direct costs in a minute. Right now, I want to touch base on applicable credits. Excuse me. So there's a list here, bulleted list of some exceptions of what applicable credits means. So what this means is if you get a rebate or you get a refund or you get funds returned to you that you drew down and paid from the grant award, those rebates, refunds need to be credited to the grant award so that the award expenditures would ultimately be reduced as a result of that. That's basically all that means. If the reduction happens while the grant award is still active, it's typically done just as a cost reduction. So in your current expenditures for that period that you receive that rebate or whatever it may be, that reduction, that credit, you would just reflect that as, in your calculation, just reflect that as a reduction, and it would reflect in your current expenditures that way. It would get pulled in that way. It's not separately reported or anything like that. If your grant award has passed that end date and is no longer available to you, then those would most likely be refunded back to the agency, is how that's ordinarily handled. So if that's the case, you'd be contacting the reporting staff or your grant manager, and they'd be working with you in terms of what options specifically are available for that situation. And then the other terminology I wanted to touch base on here was project costs. So total cost and project costs are slightly different. Total cost we touched on. Project cost is that plus any cost sharing. So some of your grant awards have leverage requirements in them. Some of you may be incurring additional costs that you're not reporting to the agency. So the total project cost is everything that's going into to accomplish the project goals. And you may or may not be required to report that cost sharing or leverage or whatever it may be. It just depends on the award and the instructions that are specified in it. Typically, we like to see, if there's a leverage requirement, typically we like to see that reported so we can see, one, that requirement was met, and two, we can kind of understand what the full cost of that project is. Okay, next slide. So direct costs and indirect costs. Every cost that gets charged to the grant award is either classified, is either treated as a direct cost or an indirect cost. It doesn't mean you report it any differently in the CEDAR system, the cash draw expenditure reporting system. This is something that has to do with how the cost gets charged to the grant award. So with direct costs and indirect costs, so I pulled some of the bullet points from UG and UGMS here, and you can see those on the screen. Basically, a direct cost is something that you can identify specifically with the grant award, or if the grant award has multiple funding streams like yours do, it's something that you can identify with a particular funding stream, PD, or the AEL combined, or if you have some other specific category that in your grant award. So that's a direct cost. You know that is all it benefits. That's what it goes to. That's what it's benefiting. An indirect cost is something that's benefiting multiple funding streams or grant awards, and it has to be assigned some way or another. And usually that's with the cost allocation plan or the indirect cost rate. And so those costs get pulled and then charged to the grant award, assigned to the grant award based on some methodology using a basis like modified total direct cost or direct labor cost or something to that effect. So a computer, for example. So if you have a staff who they're only working on the AEL grant, their computer, they had a laptop, their laptop broke, you need to replace that laptop and that individual are going to continue to be used only for the AEL grant award. That's a direct cost of the AEL grant award. Conversely, if you have accounting staff who have a computer that breaks down and you need to replace it, if that accounting staff is working on all your organization's different grants all day long, that's most likely going to be treated as some sort of an indirect cost. And there's going to be some methodology for how that computer gets, the cost of that computer gets distributed to the various grant awards and grant programs and funding streams that your organization has. So all direct costs and all direct costs and indirects ultimately get charged to the final cost objective, and which would be either the grant award or, like I said, if you have multiple funding streams in the grant award, that would be the the individual funding streams. So next. Okay, I included this slide just because indirect costs is sometimes used synonymously with the terms facilities and administration, or F&A costs. You see that throughout the uniform guidance. And in fact, every time it references indirect costs, it puts F&A costs in parentheses behind it. And that's just an additional requirement that some organizations have. They're required to further break down their indirect costs into those two broad categories. I also wanted to mention this because administration, as you see here, is not the same administration that we're talking about when you report in your administrative cost category for your grant award. So that definition, the latter, comes from the program definition itself. Every program that we have either has a definition of administrative costs that's either defined in statute regulations, or it's ones that we've applied via rule or the grant terms itself. And so under AEL, when we talk about indirect costs, all of those indirect costs, even if you break them into these two categories, facilities and administration, all of those indirect costs are going to the administrative cost category under your grant award. Oh, I see a couple of questions here. So the first question I see is, I'm wanting to make sure that my last guidance from TWC is still true. I do allow subs to have administrative costs, but I do not list the subs admin costs in my budget detail because all subs costs are listed under contractual. However, I track subs administrative costs to ensure that we do not exceed the admin cap. Am I doing this correctly? It sounds like you are. Oftentimes the subrecipient's admin doesn't count against the admin cap for the grant award. So we might want to look separately if you want to reach out to your grant manager separately, and they can get in touch with me, or at the end of this presentation is an email address. We can touch base direct specifically to talk about that question. But it sounds like you're pretty much on the right page on that. And then there's another one. Oh, is indirect costs and admin costs? And I think I just answered that question that yes, for purposes of AEL, indirect cost hits against admin. So next slide. Thanks, those are great questions. Cost allocation and indirect cost rates, obviously very complex subjects in and of themselves, and this page doesn't do them justice. But what I wanted to make, the reason I included this slide and the point that I wanted to make with this was just, when you have indirect costs, there's going to be some methodology for how those are assigned to the grant award and to funding streams. Ordinarily, indirect cost rates, if your organization has one, ordinarily it deals with the sort of organization-wide high-level indirect costs that the organization has, while a cost allocation plan might be more frequently used for costs that are direct to a specific division or department that it needs to allocate to the awards that it receives, for example. That's just one example. That's not a general one-size-fits-all rule. That's kind of just a scenario that you might kind of keep in mind. And each of these has its own unique cost principle requirements. We have the basic standards, of course, that apply to everything, to all costs. Within the UG and UGMs, they outline some specific requirements for indirect cost rate negotiation for different types of entities. And then certain cost allocation plans, they have separate requirements as well. Next slide. And on that note, so you probably all are aware, and if you're not, then here you go, spoiler alert. The Department of Education, does have a apply regulations for use of a restricted indirect cost rate. So those regulations are listed in that first bullet there, the 34 CFR 76.563 through 76.569. That's where it talks about these. And the reason that applies is because those regulations say if your Department of Education program has a supplement non-supplant provision in it, which AFLA does, then the restricted indirect cost rate applies. So there we go. It applies to our AEL grant awards that we make. And what it does is it limits indirect costs to the product of what the restricted rate is, as defined by those regulations, and what's essentially modified total direct cost. So it's your total direct cost minus things that can kind of skew or distort what costs should be, the measure should be. So the restricted rate itself, the regulations go into the calculation of the two comparisons. So you're looking at the calculation that's at 34 CFR 76564 paragraph A, and you're comparing that to a rate of 8%. So whichever of those is lower is the restricted indirect cost rate, and that's the rate that you would multiply against those modified total direct costs, roughly, of the grant award to determine the indirect cost rate. So it's not a situation where we get to just go, oh, it's going to be 8% and apply that. We have to actually think through what it should be. We have to look at the lesser of those two sub-bullets there. And all of this I'm going into because allocation is direct and indirect costs and cost allocation, indirect cost rates. The reason that's important, cost principles help determine what's allowable under the grant award. So those are helping to measure what benefit is going to the grant award from a particular cost. So if the cost allocation plan is using a methodology that's not really a good measure of benefit, or if the indirect cost rate is not being applied correctly or not being followed, it can result in the grant award being overcharged with those excess costs being unallowable, or it could result in the grant award being undercharged, which is a bad thing for your organization, because then you're left kind of holding the bucket for those uncharged costs or having to try to work it out later. So that's why I wanted to mention all of that during this session. So next slide, please. So next session is factors affecting allowability of costs. So you probably have heard it a million times, costs must be necessary and reasonable. That's where this comes from. This is where that comes from, is those factors affecting allowability of costs. And these factors apply unless there is some statutory authorization that sort of makes them null for a particular in a particular instance. So if there's a specific statutory authorization that says a particular cost is allowable, then it's allowable. So you have to kind of keep that in mind, always in the back of the head when we're thinking about allowable costs. So there are a few criteria that we think about when we're going through the general factors of allowability. And again, these we're looking at all costs. These are applying to all costs. So they have to be necessary. And it means that they have to be necessary to perform the grant award. The UG and UGMs don't go into what necessary means. They don't further define it. But if you look in the Principles of Federal Appropriation Law, which I'm sure is some nice, relaxing evening reading that all of you do, if you dig around in there a little bit, they do talk about what's necessary from a federal perspective within their own operations. And so they kind of point to the fact that when they talk about necessary, they don't mean necessary in the sense that the only costs that are absolutely a do or die situation can be charged to the grant award. That's not what it's talking about. But it also does go deeper than just something that it's a nice idea or something that you'd like to do or something that's important. It's a very relative concept. So when we're asked to think about whether a cost is necessary or not, we look at the circumstances, we look at the relationship between that cost and the grant award, we look at the grant requirements as a whole, the grant terms, the performance targets, the objectives that are trying to be reached, the law and the regulations. Like I said, that whole idea of looking at if it meets grant requirements, it's allowable, that's a deceptively simple observation. There's a lot that goes into it. So it is a relative concept. So what's necessary under one grant award might not be necessary under another. And then the other thing to think about is whether it's provided by some other fund source. So I hope this, an example I can think of is the agent TWC also makes jobs for education and training grant awards that are strictly equipment. And these are institutions of higher ed that are applying for these grant awards. Some of you may have heard of them, some of you may not have not. So they're JET grants. So if your organization applies for a JET grant, and then you decide you want to you also need equipment or that same equipment in connection with the AEL grant award, the JET grant's already funding it, so it wouldn't be an allowable cost under the AEL grant award. So you can substitute whatever grant name you want in there. That's kind of the basic point, is if it's funded and specifically authorized under another grant award, that's the purpose of that grant award. You already have funds to cover it. You don't want to cover it under this grant award. So we would think about things like that as well. And these are just examples of things. Like I said, the UG and UGMs don't define or give us criteria for how to think about necessary. So these are kind of just some points to help you think through that question. The next slide. Cost must be reasonable for the performance of the grant award. UG and UGMs are nice. They do give us some criteria to think about when we think about whether a cost is reasonable. Necessary and reasonable often go hand in hand. We often think about the two together. So these are some of the criteria that UG and UGMs do list for us to consider. There are others as well. I kind of picked out the high points. And then it also talks a little bit more detail in UG and UGMs. It talks a little more detail about reasonable costs as well. So definitely something to check out if this is something you're having to think about. Being prudent under the circumstances prevailing at the time the decision was made. So does it make sense? Is there a logical relationship? Again, what are the grant requirements? Why is it being incurred? What's the benefit to the grant award? Things like that. Is it ordinary and necessary? Is this something that's something that it doesn't really fit with the AEL grant program at all, or is it something that's a routine kind of expenditure? And just because it isn't something that's never been done before doesn't make it automatically unallowable. It's just something that's going to probably get more scrutiny than something that happens all the time. Sound business practice, there's that phrase again. We talked briefly about that before. Arm's length relationships, so kind of tying in with conflicts of interest and that sort of thing and avoiding those kinds of situations. Market prices. I think a lot of times when people think about whether a cost is reasonable or not, they just automatically think of market prices and stop there. But as you can see, that's really only one of the factors that we're asked to think about, but it is an important one. Requirements of applicable laws, regulations, etc. So this is where that's where all those other grant requirements. Does it really fit? Is it consistent with all those other requirements? Responsibilities to employees, government, public, of course, the customers, the students in this case. Does it make sense in consideration of those responsibilities? And then I mentioned this one too a little earlier, kind of touched on it about deviations from established practices. So if your policies and procedures ordinarily treat a cost one way, there would be some scrutiny involved if you suddenly treated AEL differently, or even under a particular grant award or funding stream. So that's an important one to think about too in terms of whether a cost is reasonable. If you do deviate from policies and procedures or your normal practices, you'd want to probably make a memo to your files or have something on hand to be able to explain that should you need to, in terms of why you did it. What were the circumstances? What was the logic behind it? How does that benefit and why is it necessary, and that sort of thing. Next slide. Allocable. So necessary, reasonable, allocable, and then the last one we're going to cover in a few slides is adequate documentation. These are the four that are cited, most frequently cited when we deal with whether a cost is allowable or not. Not that the other criteria that we're going to cover aren't important or less important. Those are just the four that come up most often when we deal with an allowable cost or allowable cost questions. So allocable just means is a question of whether the cost was charged or assigned to the grant award in accordance with relative benefit received. So if it's a cost that is benefiting multiple grant awards and you charge it only to the AEL grant award, that's a question of allocability. Was it charged in accordance with relative benefit received? And in that case, on the surface, it sounds like it would not be, that the grant was overcharged because it's also benefiting another grant award. So those would be kind of a question of direct costs. Indirect costs, those costs that benefit your organization as a whole, or sort of more direct programmatic kinds of costs that are benefiting multiple types of activities, how those costs are shared and distributed amongst grant awards and within those the funding streams within those grant awards if there are multiple funding streams. The next slide. So another criteria is whether the cost conforms to limitations or exclusions. So your administrative cost limits, prior approval requirements, the uniform guidance and UGMs of selected items of cost, they'll sometimes specify limitations, limit the extent to which a cost is allowable or not allowable. Idle facilities and idle capacities comes to mind, for example. So it may allow those kinds of costs for a short temporary period of time if they were unforeseen, but when you get into long periods, long expanses of time, those start to get in the realm of question cost and unallowable costs and things that have to be very carefully looked at. So those kinds of limitations should be thought about as well. With some of our other grant awards, from other federal awarding agencies, there's caps placed on salaries, there's caps placed on consultant fees. If your organization is a state agency and you're ordinarily required to follow the state travel regulations, those travel rates, those reimbursement rates, those carry through to the AEL grant award. So those are some examples of limitations, exclusions to think about. Next slide. Be consistent. I think this is the third time now we're going to hit on this. So the goal here is that the grant award is not overcharged for what its share of cost is. So if you this came up recently with the emergency pay for individuals who had to be out on leave because of COVID-19. And so one of the questions that we had to, caveat or think about was, well, what do your policies ordinarily require? How are you treating the other employees in your organization? We didn't want to treat AEL differently unless there was a really good reason to do so. So that's an example of being consistent with your policies and procedures. The next slide. Gap. It's not the thing between your teeth. If you have a gap in your teeth, it's not that. This is generally accepted accounting principles. So this is where your accountants, you definitely pull them in. This is their realm. To make sure that costs are accrued, obligated, recorded in accordance with GAAP. The UG does make some exceptions for that for state and local governments and Indian tribes, as the slide says there. And we won't go into those today, but just that's specifically noted in connection with this criteria as well. But by and large, things need to align with GAAP, and that's a question to pull your accountants into if you have questions about that. And next slide, I think we have a couple more criteria here. So we want to make sure that it's not included in cost sharing or matching. Simply said, federal funds don't get to pull down other federal funds unless there's specific statutory authority to do so. So let's say you go out and you come across this grant opportunity outside of TWC or anywhere, and you go, oh, this would be a great opportunity. This would really, really benefit. We could help this could help supplement our AEL activities. This would be really great. It lines up great. And then you see that it has a matching requirement. And you go, oh, well, since it's so in tune with our AEL grant award, we'll just use our AEL grant award as match. Typically, that's probably not going to work because especially if that federal award is that's the kind of a key thing. If that federal award opportunity that you're looking for is federal funds, and your AEL grant award is, of course, has a lot of federal funds in it. So probably that wouldn't be an option. You have to look for some statutory authority to be able to use that as match. Otherwise, it wouldn't fly. The next slide. adequately documented. So like I said, there's those 4: necessary, reasonable, allocable, and adequately documented. Those are sort of the 4 big ones that you see in terms of frequency of what's cited with respect to allowable costs. And this question comes up all the time. What does that mean? And I think monitors, when subrecipient monitoring speaks, they're going to touch on this as well, I think. It covers a lot of things. It's, again, another one that's sort of deceptively simple. So it's your accounting records, it's your general ledgers, it's your journals, the journal entries, and all of that. It's that, as well as the supporting documentation that shows, yeah, these are actually really actual expenditures that occurred. So the underlying invoices and purchase requests, purchase orders, time sheets, or whatever time recording method you use, travel reimbursement, the invoices or reimbursement requests and expenditure reports that you receive from your subrecipients, if you have subrecipients. All of that's the supporting detail for those amounts that are in your accounting system and the amounts that you ultimately report to TWC as expenditures under the grant award. The reason all of that is important, it kind of goes back to that oversight role. As entities that receive grant funds, there's a responsibility to comply with all the grant requirements, and so you kind of, it's the burden of proof is on the entity expending it that they expended it the way it was intended. And then for the oversight entities, there's an expectation of ensuring that funds were expended as intended as well. So they're supposed to go look at that and kind of test things, and that's where the monitoring all comes in. So that's why adequate documentation is so important and gets so much emphasis. I think on the next slide, I touch on what I just talked about. The other thing I want to touch on this is, there will be times when you incur costs that aren't specifically addressed by your grant award. They aren't specifically addressed by the statute or the regulations. They're not specifically addressed in the uniform guidance and UGM selected items of cost. They're not specifically addressed anywhere. And great practice is to reach out to your grant manager, of course. If you're in a situation where you don't have time to do that, you just need to make a decision, you need to make a call right then and there. It's really good idea to go ahead and make a memo to yourself, to the file, attach it to, include it in the purchasing documentation or whatever accounting documentation you have there at the time, just to make a note of what the circumstances were, what the logic was for incurring that cost, the benefit to the grant award, to detail those kinds of pieces, pieces of information. So I think that covers that slide. Yes. So some documentation practices. This is not an all-inclusive list. This is just a, hey, here's some good ideas, some things to keep in mind kind of things that have, come up over the years and over time. And I'll kind of hit on a few. Really just, if you can build it into your policies and your procedures, your regular operating procedures, what gets attached to documents, that's an ideal thing. It kind of helps to make sure you're covered. And then as far as making corrections, of course, the sort of best practice is if you need to make a correction to something, use ink, do one strike through so you can see the original, what was there originally, do an initial or signature and a date, and if you can, a little brief explanation of why the change was made. When that doesn't happen, if something gets whited out or things become illegible, it kind of brings into question, it draws more scrutiny than maybe have needed in the first place, because it draws into question of whether that person making that correction had good intentions or not. And so always just kind of keep that in mind. Ensuring documents are legible, retaining records. If you're retaining records, make sure you have controls aimed at preventing alterations so you can protect the integrity of the document. and then explain departures when they occur, and then just a normal sort of accounting internal control is using pre-numbered consecutive documents, pre-numbered purchase orders and that sort of thing, check numbers when you can. Okay, considerations relating to general provisions of cost, of selected items of cost. So if you think back to that little pyramid that we have, this is the bottom rung. This is sort of the third piece of the puzzle in terms of the components that Uniform Guidance and UGGMS cover with respect to cost principles. So first of all, if you aren't aware already, the Uniform Guidance and UGGMS cover the allowability. They describe specifically the allowability of certain items of cost. It's a good number of costs. It's obviously not all inclusive, doesn't cover everything that could possibly happen under the sun, but it's a really good start. So it covers things like accounting costs and budgeting costs and construction costs and equipment costs, idle facilities and idle capacity. I mentioned earlier, it covers travel costs. It covers a depreciation, capital expenditures, lobbying. It covers a wide variety of different kinds of costs, and it specifically talks about whether they're allowable or not allowable, or if they require prior approval, or if they there's limitations that apply to them under the UG and UGGMS. So that's what we're talking about when we're talking about selected items of cost. Relating to that, there are some things to keep in mind, and that's what's bulleted on this page, and that's the extent of what we're going to cover today, is just to keep in mind that just because something is listed as an allowable cost under those selected items doesn't necessarily mean that it's always going to be allowable under your grant award. So, for example, let me explain what I mean, because that sounds kind of confusing, I'm sure. So, equipment. If equipment is listed as an allowable cost, but that particular piece of equipment is not necessary under your grant award, and it doesn't benefit your grant award, or it's charged in excess of what the benefit to your grant award is, or if the cost isn't adequately documented, those things come into play as well. And so just because it's listed as an allowable cost under the selected items doesn't mean you get to ignore everything else, and so that's important to keep in mind as you're looking at those things. Again, it doesn't matter whether it's direct or indirect cost when it talks about selected items. It doesn't really affect allowability, except where it specifically speaks to that distinction. So again, with equipment is another example. So equipment ordinarily is only allowable as a direct cost, and even then requires prior approval. The cost principles specifically say it's not allowable as an indirect cost. Proposal cost, if the cost of putting together a proposal for a grant opportunity, it talks about charging those as indirect costs. So it does make some distinctions in there, but it doesn't as a general rule, doesn't only apply to direct costs or only apply to indirect costs. Then the other thing to keep in mind is that the costs that are covered in the Uniform Guidance and UGGMS are, like I said, it's not a comprehensive list. So there can be other costs that occur. So just because a cost is not listed doesn't mean that it is either allowable or unallowable. Then you have to think about, well, is there a cost in there that they've addressed that's very similar to the kind of cost that I'm incurring, and how is that treated? And what's the relationship between those two? How similar are they? Is that an appropriate treatment for the cost I need to charge? Or you also fall back on those general allowability criteria that we talked about just a few minutes ago. Is it necessary? Isn't it reasonable? Is it allocable? Do you have adequate documentation for it? The whole cost sharing, consistency, etc. So those are all things that still apply regardless of whether it's specifically addressed it as a selected item of cost or not. And then this last item, it's important to keep in mind as well, in the event of a discrepancy between the UG and UGGMS and the federal award that TWC receives, the federal award will prevail. So what that's referring to is that if if we receive obviously a federal award from Department of Education, and within it, it has terms and conditions listed in it, just like your grant award has terms and conditions listed in it. And if there's something in there that they've added that has specifically authorized or specifically prohibits a cost, that's going to prevail over whatever UG and UGMs say for that cost. So we, of course, pass those requirements down to you, and they would reflect in your grant terms. So, next slide, please. Prior approval. So some costs do require prior approval, and as I mentioned, the grant uniform guidance and UGMs do specifically point out prior approval requirements for certain costs. The entity that has to approve those varies. So if you come across a cost that it says it has to be approved by the pass-through entity or the federal awarding agency, those costs need to come to TWC. It also needs to come to TWC, of course, if it says that prior approval from TWC is required. That's obviously going to come to TWC. So any of those. There's also situations in the uniform guidance and UGMs where it says that prior approval is required from the federal cognizant agency for indirect costs. Those don't need to come to TWC unless you just kind of want to keep your grant manager in the loop on it. That's fine. But we don't have any role in the approval of that unless we by chance become the entity that negotiated that indirect cost rate with you or cost allocation plan with you. So that's a separate matter that we're not really party to. When there are prior approval requirements that says you have to submit it to TWC, your pass-through entity, or the federal awarding agency, those go to your TWC grant manager, and they get it coordinated and organized and going where it needs to go to proceed in terms of whether TWC can approve that cost or not. If it is something that requires federal approval, of course, we have to run that up the chain through appropriate channels here to request that approval. And of course, we can't approve it we can't give any approval until we get their concurrence to do so. So that takes a little more time. We have a separate form specifically for equipment. Equipment, and the reason we have one for equipment and equipment only is because it's a fairly common amongst all of our grant awards. It's a fairly common recurring request. So we have a separate form for it. If you need that form, you request it from your TWC grant manager. Anytime you're purchasing equipment, it does require prior approval. So you'd want to make sure you get that form and submit that to your grant manager so it can be reviewed. And of course, it's all the brakes are on until you get the okay to proceed. And it's possible that you might not get an okay, and you certainly don't want to be left holding the bill for that if you don't have to. So next slide. Okay. We're winding down to the end here now, and sadly we're going to end with unallowable costs, which is just a sad subject. Nobody likes to deal with these, and nobody wants these. We do all have responsibilities to deal with them, though, of course. So as far as monitoring, this rolls in under our oversight responsibility. So our monitors will come and look at grant awards, and they'll pull expenditure samples, and they'll pull eligibility files, and they'll pull all sorts of things to verify that it looks like the grant was managed in accordance with the grant requirements. When there are questioned costs that are identified, question cost meaning that it doesn't look like it's allowable, maybe there's not enough documentation to determine whether it was handled appropriately or not. Those get handled through an audit resolution piece, which I'm sure our monitors will cover with you during their session. And that gets worked out. And if it doesn't get worked out to your favor, meaning you're unable to demonstrate that it was expended as it should have been, then those funds obviously come back to us. And that's really especially the case if the grant award has already ended, that period has already closed. And we don't have any flexibility, unfortunately, to turn the other cheek, turn our head, close our eyes, do like the three monkeys, the closing our eyes, ears, and what is the other, mouth? And so, yeah, everybody who makes a grant award has that responsibility to look at that oversight and make sure that they're following up on those improper expenditures. Next slide, please. So some of the allowable cost findings, and again, you might see some of this during the monitoring session, but inadequate justification for food and beverage cost. Food and beverage cost, as a general rule, it's kind of good to treat those as if they are going to be unallowable to begin with. They get very closely scrutinized. Anytime there are food or beverage costs that are charged to a grant award, they get very closely scrutinized. It's not a cost that the Uniform Guidance and UGM specifically prohibit. And in fact, they kind of comment on it being okay in certain instances, but it is still one of those costs that from the outside looking in, we don't want a lot of grant funds being expended on that kind of cost. And when we do see it, we need to be certain that it is something that's necessary, that it's reasonable, that there's a benefit to the grant award. What was the logic? What were the circumstances, et cetera? So mark that, if nothing else. Memorabilia purchases, not allowable. Clothing apparel for employees, generally not allowable. There are a few exceptions here and there specific to circumstances. For example, some of our grant awards are camps for youth. And so there are instances where T-shirts are purchased so that everyone can be identified as being part of a particular group so nobody gets lost. So we can keep up with everybody because that's important. We don't want to lose kids. That's bad. And so, so clothing apparel in that respect. But purchasing things like jackets with the organization's name on it and T-shirts to wear on Fridays, those would not be allowable costs. Outreach items that have no connection to the program. So in recent years, there have been situations where a lot of giveaways have been purchased, and the feds have kind of become a little more stricter on that, and so we've become a little more stricter on that as well. So giveaway items that you're calling outreach, so pens, pencils, that sort of thing, be very careful about those kinds of things as well. That's another one, like food and beverage costs, to basically assume it's unallowable, and if you do it, make sure you have it well documented why you did it. And also those kinds of costs, it's really a good idea to reach out to your grant manager as well and go, hey, what do you think of this? And get that sort of TWC feedback or buy-in beforehand. And they may send it over to me and we'll comment on it, but always start with your grant manager on things like that. Purchasing of decor for a meeting, also not allowable. Generally speaking, I can't think of instances when it would be allowable. Travel without explanation of a business need, so that's just a documentation piece. Merit increases without supporting documentation, again, a documentation piece. Ineligibility, because it's not documented, it's a documentation piece. And then journal entries with no supporting detail, a documentation piece. Moving on to the next slide. So some practices to help avoid unallowable costs, or operationalizing those administrative and cost requirements. So just building it into your written policies and procedures, building it into your operating procedures, even if you don't have it written, making those controls of scrutinizing and checking for documentation and sort of looking at it through the lens of an auditor or a monitor or someone else, or the general public. Does this look okay? So that's one piece of it. Of course, reading and understanding the grant requirements, that's 101 in terms of grant management, right, is to make sure you know what your requirements are. Maintaining, reviewing, and testing your policies and procedures. This is part of the internal control structure that UG and UGMs talk about. They talk about the COSO requirements and the Green Book. So that's just part of the control environment, is to make sure that there are policies in place, procedures in place, internal controls in place, and just periodically testing those. If you have an internal audit function, they're probably doing some of that for you. It's probably happening as part of your regular management oversight as well within your organization on a day-to-day basis or periodically, just to make sure things are going the way that they should and that those controls are operating the way that they should. Training and overseeing staff, so making sure that folks who are making decisions about allowable costs are familiar with the cost principles and know what requirements apply under the grant itself, the other requirements. And make sure you have appropriate oversight of those individuals. Sort of a second set of eyes, management sign off, that sort of thing. Information flow and communication with within the organization, scrutinizing purchase requests and decisions, separately tracking unallowable costs. If you do identify within your organization an instance where, oops, that shouldn't have been charged to the grant, it was incurred for the program, but it's not allowable under the grant, you want to make sure you pull those out and get them reported separately. If it was reported in the cash draw expenditure reporting system to TWC as an expenditure, you want to reverse that and get that credited, and then get that out of your into sort of isolate it so it doesn't get charged again. And then demanding adequate documentation. So this is just your internal control scrutinizing to make, like I said, looking through that outside lens to say, hey, would I be okay with this if I were outside looking in? So I think that's all I have today. Yes. So today we've touched on the role that cost principles play in grant management, and we've touched on the where to find the cost principles themselves. And we've touched on other topics like the factors affecting allowability of cost, what's a direct cost versus an indirect cost, and how does that play into the allowability decisions. And just now we've talked about the sad subject of unallowable costs. So I hope this session helps you all avoid unallowable costs and question costs, and you have great and happy accomplishments with your grant awards. So with that, I don't have anything else, and I don't see any additional questions in the Q&A right now. So I'm just going to stop here. Oh, there is the email address on the website on the screen here, fiscal.ta@twc.state.tx.us. That's how you reach me. Again, if you have questions about specific grant costs, I would strongly encourage you to reach out to your TWC grant manager. But if you have questions about things that I covered today in terms of, explanation, you weren't quite following some example or whatever that I gave, please feel free to reach out to me. I'd love to talk with you, and we can go from there. So thank you, and thank you all for having me today.
And Jenny, there are a couple of questions that have just come in the last minute or so. If you want to take a look at the Q&A.
Okay. I'm only seeing the two that I addressed earlier so far.
So we have one from Michelle Lamont at 11:29.
Sorry, user error. Let me scroll down the Q&A. I'm sorry, you guys. So there was a question about when you get the indirect cost section, are grantees eligible to elect the de minimis indirect cost option? Yes, and I'm sorry I didn't mention that. I meant to kind of do that. Yes, so the UG, the uniform guidance, does give a de minimis indirect cost rate option of 10%. We need to look. I haven't personally been involved in how that relates to that restricted indirect cost rate with the Department of Ed limitation. So if you're doing the de minimis rate, we may need to take a look at how that relates to, like I said, that restricted rate. But you're right, the UG does offer the option to do a 10% de minimis rate in lieu of having a negotiated indirect cost rate. My initial gut thought on that is that likely we would be limited to 8% as opposed to 10% based on the lesser of the two. But we, like I said, want to look at that. So feel free to reach out to your grant manager if that's something that you're looking at, and they can reach out to me and we can work through that. How much is the admin cap for the grant award? Well, it varies depending on your grant award. So if you have a competitive grant award, I think, let me do this. Let me say this instead of getting myself in trouble. It would be specified in your grant award. Look at that. The allocations that went out because of the use of the AEL combined, it changes has changed now from year to year, so it's a little handled a little differently. It's just kind of the average of the AEL federal and the GR and the TANF admin limits. So that changes, and your grant manager can help you with that. I know they have that information, or I believe they have that information fairly handy. I think it went out with allocation data that was shared with the AEL providers. So look to your grant award. Otherwise, reach out to your grant manager. And then, Joe, you asked the question about matching. If the grant being pursued is not federally funded, for example, from a private corporation or non-governmental organization, could AEL grant dollar service match? It would depend on the particular opportunity. There's nothing that I can think of in the Uniform Guidance and UGMS that explicitly prohibit it. It would just be a matter of of looking at that grant opportunity and how it fits with the this sort of limitation that we have within UG and UGMS. So that would be on a case-by-case basis. Again, something to either talk with your grant manager about or reach out to the fiscal TA email address. And the acronyms, UG and UGMS. Sorry, I covered that only once at the very beginning. So UG is Uniform Guidance. This is the Office of Management and Budget, Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards. See why we say UG? It's much shorter, much less of a mouthful. So that's what UG is, and that's codified at 2 CFR Part 200, which means Title II, Part 200 of the Code of Federal Regulations, if you're not familiar with that terminology. And then UGMS is the Uniform Grant Management Standards. So that's published by the Texas Comptroller of Public Accounts. You can find it on their website. We also have a link to it on our website. It's referenced in your grant awards, just like the Uniform Guidance is. And like I think I said before, the two are very similar in terms of the kinds of topics that they cover. Just they're not exactly the same. And so we have to think about both of them. Apparel for recruitment event is or is not allowable. That is a question I would encourage you to talk with your grant manager about. Grant terms vary. I don't have them memorized. I wouldn't want to mislead you. I would guess on the surface that probably not. Just in terms of the necessary, you'd have to make a pretty hard case to show that it's necessary for the performance of the award. So we definitely would think through that with you, or talk through that with you in terms of what your logic is for it being a necessary and reasonable cost. But again, reach out to your grant manager if you have a question about that. On slide 34, the heading says allowable cost findings, but the discussion seems to say these are not allowable. Good observation, yes. My intent was just to mean that, yeah, those are findings because they are unallowable. But yes, thanks. I'll try to make that correction next time I give this presentation similar to this. Good observation. And I think, is that everybody now? Oh, no, there's one more. Apparel for staff recruitment, not students. So that's kind of a follow-up to the other one. So I think I've got them all now.
There's one more that just came in from Kathy.
Okay, I see it. About the indirect costs. In other grant programs, there's a 10% de minimis indirect cost allowance. Also, what is the admin cap for the grant award? So I spoke to both of those just a few minutes ago. For the de minimis, we want to look at that on a look closely at that. I myself haven't looked closely at how that de minimis rate would relate to that restricted rate for an AEL grant award. So we'd want to take a look at that. And the admin cap should be specified in your grant award. If you're talking about the allocations that just happened in July 1, the grant managers would have those percentages for you if they're not already made clear to you. And I think that is all. I hope that answers everybody. Great questions, y'all. Thanks.
Thank you so much, Jenny. This is Mahalia. Great questions too coming in. I will say for Kathy and some of anyone else out there that's got questions on the recent allocations for year 3 funding, we're going to be putting out an AEL letter, and it will include in there not only the allocations and the attachment of what was approved in terms of allocations, but it will also have a breakdown of all the cost rates as well in terms of your admin, which I believe is 7.3%. But that letter is through the pipeline right now. It should be coming out for 48-hour review any day now. So hopefully you'll be getting that by next week sometime. So great question there. I just wanted to thank Jenny, and even though you ended on what is not allowable, that kind of tees us up for our starting point for tomorrow. So I wanted to get that out there to everybody, because starting at 9 a.m. bright and early tomorrow, we will have our subrecipient monitoring department going over monitoring for AEL grant compliance. So fun topic. We all love compliance, Jenny, just like you. At least I know that I do. So we hope that you guys will join us. I just want to thank everybody again for being with us today, and especially our presenter for taking your time. Great information, very helpful. I learned a lot, and hopefully our folks joining us did as well. And I think we had upwards of over 150 people on the call today, or 120 or something. So lots of good information being shared out there. I hope everybody has a very pleasant day. Don't forget to fill out the survey link and the Q&A. Give us some feedback there. We're looking to probably have something like this every year moving forward, so we can get more people involved in these conversations. So give us some feedback. We use it. It's very helpful. And have a great day, everybody. Thanks a lot.
Thank you, Mahalia. And to close, please remember to go ahead and give us your feedback for that post-session survey. The link is found under the My Featured tab, the Featured tab under your Q&A, and it'll only take a moment. We really appreciate you. This last session, we held steady at 117 participants, so that's wonderful, and we appreciate you being with us. Thank you so much, and we'll see you tomorrow.